If you are someone in the US with foreign assets, such as an offshore bank account or business activity, did you know that in many cases you have to file foreign reporting forms with the IRS even if you're not a citizen? Many people don't, and it's easy to get caught. So today, I'm going to share some of the most common foreign tax forms, who they apply to, and what to know about each of these forms if you hold foreign assets. Hi, I'm Andrew Gordon. I'm a CPA and attorney, and over the years, I've helped hundreds of clients navigate one of the most complex areas of tax law, reporting foreign income, assets, and accounts. Let me give you an example. A few weeks ago, a client came to us after moving to the US from abroad. He had several foreign bank accounts, but he had no idea that he was required to report them. Unfortunately, he missed filing an FBAR and ended up with hefty penalties. This is a common scenario. Many US taxpayers with ties to other countries, whether through foreign income, investments, or bank accounts, don't realize that these accounts must be reported. If you don't comply, the penalties can be severe, but with the right guidance, it's entirely avoidable. At Gordon Law, we've focused on foreign reporting for over a decade, helping clients stay compliant and avoid costly mistakes. Today, we're going to talk about some of the key forms involved in foreign reporting and what you need to know to stay on the right side of the IRS. Let's get started. Form 2555, Foreign Earned Income. The first form we're going to talk about is Form 2555, which allows US persons living abroad to exclude a large portion of their foreign earned income from US taxation. As a US person, you are still required to file and pay on your worldwide income, which can be a huge burden for US citizens or residents living abroad. The Foreign Earned Income Exclusion, or FEIE, provides relief by allowing you to exclude up to $126,500 for tax year 2024 of your foreign earned income from US taxes, significantly reducing your US tax bill. However, it's important to note that while this excludes up to that amount of your US income, you are still required to file your taxes and claim the exclusion using this form. To qualify for the FEIE, you must meet one of the following tests. Bona fide residence test. You must be a bona fide resident of a foreign country for an uninterrupted period that includes a full tax year. Or physical presence test. You must be physically present in a foreign country or countries for at least 330 full days during a 12-month period. While you're still responsible for reporting and paying taxes on your worldwide income, the FEIE allows you to reduce your US tax liability, making it easier to live and work abroad without being overly taxed by both the US and your country of residence. FBAR, or FinCEN Form 114. If you have bank accounts or other financial assets outside of the US, understanding the FBAR, Foreign Bank Account Reporting, is critical. FBAR, or FinCEN Form 114, is a required form for any US person who holds more than $10,000 in an offshore account at any point during the tax year. These accounts aren't limited to bank accounts. They include retirement accounts, trusts, life insurance policies that earn interest, and many other types of financial accounts held in foreign countries. It's also important to remember that the $10,000 threshold is the combined amount across all of your foreign accounts. So even if no single account hit $10,000, if your total amount across all foreign accounts exceeds $10,000, even for a single day, you are required to file the FinCEN Form 114. Now, who exactly is considered a US person? The IRS considers you a US person if you are a US citizen, US residents, including those who hold a green card or meet the 183-day residency test, anyone who elects to file a US tax return in their first year of residence, and US entities, including corporations, partnerships, and trusts. If you meet the criteria for a US person and have more than $10,000 in foreign accounts, filing an FBAR is mandatory. If FBARs are news to you. You're not alone. Many people are unaware of this requirement, which often leads to unfiled forms and hefty penalties. Fortunately, if you missed filing an FBAR in the past, there are correction options, such as delinquent FBAR submissions, the streamlined offshore disclosure procedures, or the IRS Voluntary Disclosure Program. If FBAR applies to you and you haven't complied, it's essential to act quickly because penalties for non-compliance can be significant and financially damaging. If these options are overwhelming, reach out to us. We can walk you through it in a way that you can understand. Form 8938, FATCA. Now let's talk about FATCA, which stands for the Foreign Account Tax Compliance Act, and specifically Form 8938. This form is used by U.S. taxpayers to report certain foreign financial assets to the IRS. FATCA was designed to prevent tax evasion by U.S. taxpayers who hold assets overseas, and it requires detailed reporting to ensure compliance. So, who needs to file Form 8938? If you're a U.S. citizen, resident, or certain non-residents, you have financial foreign assets that exceed certain thresholds, you are required to file this form with your annual tax return. The thresholds vary depending on your filing status and whether you live in the U.S. or abroad. Single or married filing separately while living in the U.S. More than $50,000 at the end of the tax year, or more than $75,000 at any point during the year. Married filing jointly, also living in the U.S. More than $100,000 at the end of the tax year, or more than $150,000 at any point during the year. Single or married filing separately, living abroad. More than $200,000 at the end of the tax year, or more than $300,000 at any point during the year. Married filing jointly, living abroad. More than $400,000 at the end of the tax year, or more than $600,000 at any point during the year. What types of foreign assets must be reported? Form 8938 covers a broad range of foreign financial assets and accounts, including foreign bank accounts, foreign stocks and securities, foreign mutual funds, foreign pensions or retirement accounts, and interest in foreign partnerships or corporations. It's important to note that FATCA reporting is in addition to other foreign account reporting requirements, such as FBAR. Just because you filed an FBAR doesn't mean you can skip Form 8938. Both may be required depending on your situation. Failure to file Form 8938 when required can lead to steep penalties, starting at $10,000 and increasing the longer you fail to file. The IRS also has the authority to extend the statute of limitations if FATCA reporting is incomplete or inaccurate. Given the complexity of FATCA and its wide-reaching implications, it's essential to review your foreign assets carefully each year. Form 5472, Foreign-Owned Corporation. Now let's talk about Form 5472, which the IRS uses to monitor U.S. corporations with significant foreign ownership and foreign companies doing business in the United States. We get calls all the time from companies that receive penalties for Form 5472 and didn't know they had to file. So who needs to file Form 5472? The requirements include U.S. corporations with at least 25% foreign ownership and a reportable transaction, foreign corporations engaged in a trade or business within the U.S., and U.S. disregarded entities that are wholly owned by a foreign person. Failure to file Form 5472 comes with significant penalties. If a business fails to file the form by the due date, the IRS could impose a hefty penalty of $25,000 per form per year. And if the failure continues for more than 90 days after the IRS sends a notification, the business will face an additional $25,000 fine. The same fine could also apply to an incomplete form, which the IRS considers a failed filing. Given the complexity of these reporting requirements, it's crucial for businesses with foreign ties to be aware of their obligations under Form 5472 to avoid costly penalties. Let's dive into Form 8621, which is used to report income from passive foreign investment companies, or PFICs. While you may think you don't have a PFIC, this form applies in several situations. So, what is a passive foreign investment company. A PFIC is a foreign corporation that primarily generates passive income, such as dividends, interest, or capital gains, rather than running an active business. Essentially, it's a company where 75% or more of its income is passive, or 50% or more of its assets produce passive income. One common way U.S. taxpayers unknowingly invest in a PFIC is by purchasing shares of a foreign mutual fund or exchange-traded fund. Because these foreign investment vehicles often meet the definition of a PFIC, it's easy to overlook the need for reporting. You're generally required to file IRS Form 8621 if you receive income from a PFIC. However, even if you didn't receive any distributions, you might still have to file this form if the total combined value of your PFICs meets certain reporting thresholds. One thing to keep in mind, some PFICs are categorized as qualified electing funds, or QEFs, where U.S. shareholders can elect to be taxed on their share of the company's income each year, even if they don't receive distributions. These types of investments come with more complex tax rules, so it's important to be aware of your obligations if you've invested in a PFIC. If you're a U.S. taxpayer with foreign investments that may fall under the PFIC rules, it's crucial to determine whether you need to file 8621. And if you're unsure about the specifics, reach out to us. We'll help you navigate the complexities and ensure that you're compliant. Form 926, Foreign Property Transfer. This last one is a little bit more specific, but it's still important to know if you're living, working, or investing outside of the U.S. IRS Form 926, also known as a return by a U.S. transfer of property to a foreign corporation, is used to report certain transfers of cash or property from U.S. taxpayers to foreign corporations. You are required to file Form 926 if you transfer property to a foreign corporation where the value of the property exceeds $100,000 during the tax year, or you own 10% or more of the foreign corporation after the transfer. This form tracks outbound transfers of property to foreign entities and reports any gains or losses that might be realized as a result of the transfer. The rules surrounding Form 926 are complex, especially when determining the type of property being transferred and its value. So if you're not sure whether you need to file, it's a good idea to consult a tax attorney. Failure to file Form 926 when required can bring serious penalties. The IRS imposes a penalty of 10% of the fair market value of the transferred property at the time of the transfer. Additionally, if the underpayment of tax is linked to an undisclosed foreign financial asset, the penalty can jump to as high as 40%. Those are some of the most common IRS offshore forms, but they are just the start. If you want to dive deeper and learn more about other forms, what they're for, and who needs to file them, check out the resources on our website. The link is below. We've got straightforward explanations to help you navigate the complexities of offshore reporting. If you're a U.S. taxpayer and have been involved in income, corporations, or investments that took place overseas, you need to make sure that you are filing all applicable forms with the IRS before your 2024 taxes are due. Have questions about offshore forms or not sure if you are compliant? I'm here to help. Feel free to reach out for a confidential consultation, or if you need assistance with filing any of the forms that we talked about. If you found this video helpful, give it a like, subscribe, and share it with someone you know who has worked or invested overseas. Thanks for watching, and see you next time.